So how to buy tax lien certificates in California. In this video, I'm going to show you actually how it works in California. It does work in California, but there is a nuance into this. I'm going to show you how California works, what to look out for, what to be excited about, and most importantly, I'm going to show you by the time we get done, step by step through the whole process on how you can profit from this. Now listen, if you like these videos, the first thing you can do is this. Okay, thumbs up, subscribe, hit that bell. We've got so many videos on different things around the country on how tax lien certificates work. I'm going to start off with this. We are going to focus on California, but if you're focusing on one area, you're already making a mistake. I'll just leave it at that. I'll explain that a little bit later. How does California work? First of all, we need to get the terminology right. Yes, they have tax lien certificates in the state of California. They don't sell them very often. In fact, I only know of one off the top of my head that happened back in 1998 in Orange County. Okay, so in 1996, Governor Wilson in July changed the rules in California and said counties can elect, I think it is the right term, somebody can look it up, I don't really care, elect to sell tax lien certificates. First, we were pretty excited about it because it looked like if you interpret that as a county, you could sell tax liens and tax deeds. So let me stop right there. Let me explain the difference. These are two different sides of the same coin, excuse me, okay? Virus, vaccine, okay? Tax lien, tax deed, okay? They're the same thing, just two different sides. A tax lien certificate is the opportunity to buy the delinquent taxes from the county, and they give you, in turn, the interest rate when the property owner comes into the county, not you, to pay the delinquent taxes. That money is put into the county treasurer, and in 5 to 10 days, it goes back to you plus the interest rate. If the person doesn't come in within usually 2 to 3 years, whatever that redemption period is, you have the opportunity to foreclose on the property because literally you're the county's position, thus eliminating all liens and encumbrances on that property, and you own the property free and clear of any mortgages, any IRS lien. Aunt Sally, Aunt Sally has a lot of liens, I'm telling you, whoever that might be. On that property, you will own it free and clear. That is the top side of this coin. That's the heads, if you will, okay? The tail of this coin is a tax deed. Now, a tax deed means you go into the county at the sale, put your hand up, and they say sold, and the property is sold to you for the back taxes. You will never see a property tax deed at a sale unless they've been delinquent a minimum of, anybody guess how many years? Anybody? Bueller? Okay, 4 years. So it has to be 4 years. There's the other side of the coin. Now, they've owed taxes for 4 years. They probably have an interest rate for 4 years, but they owe it to the county, and no one was able to purchase it from the county. For whatever reason, that state said, we're going to offer tax deeds, but if the property owner comes in during that time period of 4 years, 5 years, whatever they have, it's got to be a minimum of 4, then they're going to pay the county. The county is going to collect the interest, and there you go. That doesn't make a whole lot of sense if I'm running a state. Not that government has to make any sense. They're not accountable to anybody but the voters, and sometimes voters don't get this. Like, let's just take the state of California, which we're talking about. California is a tax deed state. If they want to sell a tax lien, they can. I mentioned in the very beginning that there was one back in 1998. So let's go back to what I was saying. In 96, Governor Wilson passed the rules. So we thought, my buddies thought, that they were going to be able to sell liens and deeds like Florida does. There's several hybrid states out there. We won't go through all those right now. Okay, great. They're going to sell liens and deeds at the same time, and depending on which county it is, and we're going to have the best of both worlds. It didn't happen. So in 1998, Orange County, if anybody remembers, just south of LA there, filed bankruptcy. And what's the one way that they got out of bankruptcy? Almost immediately, actually. They held a supplemental tax lien sale. So they took all the taxes that were owed in that county on properties, boom, they held a sale. Now, I'm not saying there's a coincidence that Governor Wilson passes this rule, and 2 years later, Orange County had to use that rule. It sure smells like a rat, and the wind's coming from Orange County. Let's just put it that way, because it's never happened since. Okay, so nothing really has happened since then. Now, can California offer tax liens? They can. But again, you're dealing with the county. Why do they need to? 99.5% of all property taxes in the United States are paid. The gap that you and I are working in is only 0.5% of all the properties. Now, that 0.5% is billions of dollars. Okay, that 0.5% pays 18% in a tax lien state. So what California does is says, well, we're not going to do anything. Now, if you pay late, you're going to owe the county the money plus the interest. But we're not going to offer those up for sale to the general public until they've been delinquent 5 years. I know for a fact in all of the classes I teach around the world here in the United States, I mean, we do literally hundreds of classes every single year. In advanced classes, we do at least 75 advanced classes a year somewhere in the United States. And this is the most important part of the class, is understanding fundamentally what's the difference between a tax lien and a tax deed. So if I was a county, why would I not be collecting money every year from these people? Because if you look at LA County, San Bernardino, and Orange, let's just take the Tri-County in the LA area, you're talking hundreds of millions of dollars in uncollected property taxes that those counties can't utilize. And so there's this rolling accounts receivable of 5 years. 5 years. Okay, what makes Apple computers so brilliant is they have no accounts receivable. So when AT&T announces the new iPhone 87 or whatever it is, and they have this big sale and they want everybody to come down to AT&T, those phones are paid for to Apple immediately. Apple doesn't provide a float. If you understand financials, having 0 ARs and pushing your APs out 35 days, and if you don't understand that terminology, it doesn't matter, but that's what makes a brilliant company. The state governments in California, they're like, yeah, we'll wait 5 years before anybody has to pay. Hey, it is what it is. The good news is when you go into a sale in California, you're buying the property for the delinquent taxes. There are dozens and dozens of counties in California. Some of them are big. Some of them are big with a lot of population. Some of them are big with little population. So you've got to pick those. And their sales happen randomly throughout the whole year. San Diego used to do them in September, and then they moved them. Why they moved them, I have no idea, but they did. They moved them. 30 days prior to the sale, the list comes out. And here's the thing. Be interested. Don't start doing research on these properties. As soon as I want to see you doing research on this list is 15 days prior. You want to do an ancillary pass, find out where the properties are, 15. 10 days, start digging in a little bit. 5 days, dig down and find out if these are where you want. Find out what your maximum bid is going to be on these properties and bring cash. Now, here's a really nice thing. Actually, you don't need to bring cash. In California, there's a rule in there, and you're going to have to look this up because I'm kind of taxing myself. I know I helped a student of mine do this one time. I do believe it's like 5% of your bid, and then or 7%, whatever is greater. The balance is due in 90 days, or I think it's 120. So if you bid $100,000 on a property, you got to put $7,000 down and bring the balance in within 90 days. That's not a bad little deal. Now, they're not going to call this a finance program. When you're talking to the county, you want to ask, when is all of the money due after the auction? Don't ask if they have financing, because they wouldn't call that financing. To you and me, it is. Now, you have to qualify in order not to pay it all. You have to be at least 18 years old and able to sign your name, and you're in. There's so many nuances in here to make money that we can't possibly cover in this video. So this is what I'm going to do for you. I'm going to offer you a free mini course. All you have to do is click the link down below. This will walk you methodically through the history of tax lien certificates, how they work, how they convert into tax deed certificates, and everything that you need to do to go ahead and take action here in the next 30 to 45 days. Click the link down below. I'll see you on the other side. God bless and good luck.